I'm Susan Albring. I'm a professor of accounting in the Lubin School of Accounting at the Whitman School of Management. I was a tax senior for PricewaterhouseCoopers in the New York office prior to earning my master's degree in accounting at Whitman, and then my PhD from the University of Arizona. I currently teach taxes and business strategy in the MS in Accounting program, and I'm an associate editor for Advances in Accounting. I'm excited to have two alum with us, and so I'll introduce each of them, Mitch Franklin and Mark Reed. So little background: his undergrad degree from Whitman in 1999, and then his master's degree also from Whitman in 2000. He's an associate professor of accounting at Lemoyne College, Madden School of Business in Syracuse. He served as department chair for over 4 years. His research interests include the impact of tax law on tax policy and also pedagogical issues in both taxation and financial accounting. He's the incoming editor of a leading individual taxation textbook that's widely used across the country. He's published over 50 articles in journals, including Issues in Accounting, Advances in Accounting Education, and many other journals. He's presently serving on the editorial board of Issues in Accounting Education. He's also the associate editor for the Accounting Educators Journal. Professionally, he serves as the president of the American Accounting Association Northeast Region and serves as chair of the 2023 American Taxation Association Conference for Teaching and Learning. Prior to joining Lemoyne, he served on the accounting faculty at Whitman School for 15 years. And I'd also like to introduce our second panelist, Mark Reed. He's also an alum. He graduated with his MBA from Whitman in 1984. He's a senior advisor at Furley Moran Freer and Isa CPA PC in Syracuse, New York. Prior to this, he was the managing tax partner for the firm for about 26 years. Reed specializes in partnership and also individual taxation. He focuses primarily on the energy generation industry and also assisting affluent individuals. He's the treasurer of the Arc of Onondaga Foundation in Syracuse and also serves on the accounting advisory board for the Lubin School of Accounting at Whitman. Prior to joining Furley Moran Freer and Isa, Reed served in various capacities in industry and also with Ernst & Young. In terms of our agenda for today, Mitch is planning to discuss tax implications related to COVID-19 for individuals. Topics he will cover include the child tax credit and advance payments, including a discussion of the credit, how it will work, and also what happens in 2022. He will also discuss the meals and entertainment deduction and the related changes from the 2020 Rescue Act. He'll also discuss changes to student loans, including the suspension of interest payments and issues related to qualified retirement plans. And he will also discuss medical expenses. Mark is planning to discuss tax implications related to COVID-19 for small businesses and also pass-through entities. Specifically, Mark plans to discuss pass-through entity tax considerations, Internal Revenue Code Section 461I excess business losses, and then also rules related to net operating losses. Mark will also cover issues related to remote working, including state taxability to the employee, withholding rules for the employer, unemployment insurance, and also workers' compensation insurance. So Mitch, I'll turn it over to you now to discuss the individual tax considerations related to COVID-19.
Okay, so thank you everybody. Thank you everybody for coming today. I'm glad to be here. I look forward to talking to you about some of the individual tax implications as a result of COVID-19. And you know, I'll be honest with you. Our goal today is just to give you a very, very broad overview. I could talk to you for an entire day on this if I gave you all the details. So we'll give you an overview. And the other thing I do want to quickly say here before we get started is there is a little what us professionals call disclaimer at the end. Just to reiterate what you're going to see at the end. We're doing this today to give you general information, educational advice. Before implementing any of this in your own tax return, you should consult with your own tax advisor who can professionally advise you on this. Okay, so let's first talk a little bit about those advanced child tax credit payments that were all over the news this summer. And not only were they on the news, but one thing that I always see is when you watch the news, make sure you also do your homework, because sometimes the news reports things in some way, but it's not always the most accurate, especially when it comes to stuff like taxes that can be complicated. And one of the things that we really heard a lot of was, okay, you get this advance payment, but you're all going to have to pay it back. So take your money and save it because you're going to have to pay it back, which isn't necessarily the case. So we'll talk a little bit about that and how it works, etc. So first of all, what is a tax credit and what made this credit so attractive as a way to provide stimulus and put money in everybody's pocket? A tax credit is basically what the IRS says, we're going to take money off your tax bill. So you have a bill for $1,000, you get a $100 credit, you owe us $1,000 in taxes, we're taking $100 right off the top. So by taking it off the bill, you pay the government less, you have more money in your pocket, in theory. So what was done here is, rather than say, wait until you file a tax return and we'll give you a credit, they're saying, we're going to give you a check now for what your credit would be. And if you get that check for what the credit would be, and you didn't owe a tax liability in the first place, it's money in your pocket. All right, you don't have to wait to get it off your bill. If you're in the small number of people who got the credit in advance but had a tax liability, you might end up paying taxes, now in April that you wouldn't have paid had you taken the whole credit when the tax return was filed. So you're basically getting your discount, your money off the bill in advance is essentially what happened. And the way this credit worked is, this was a temporary measure that was provided in the $1.9 trillion American Rescue Plan that President Biden signed into law back in March 2021. So what the credit did was it upped the child tax credit from what was always $2,000 to $3,000 per dependent between the ages of 6 and 17, and from $2,000 to $3,600 for children that were 5 or younger. Okay, and what made this difference is you were able to get up to half of that money sent in an advance between the months of July and December. So unless you opted out, you got a monthly check for what would be approximately half of what your credit would have been between the months of July and December. Okay, and an eligible parent who received the advances, okay, you get the other half of the credit when you file your return this year, if you haven't filed your return yet for the current year, your 2021 return. Now, where the issue comes in with this is this benefit has, at this point, lapsed for the 2022 year. So as of now, the 2022 tax credit, which you'll get when you file next year, goes down from what was the $3,000 or $3,600 if you have under 5, back to $2,000 to any child 17 or younger. So we're losing $1,000 of the credit for this year. And the reason why it's reverting back to the way it was is because Congress hasn't passed any extension of last year's benefit, nor has any extension passed at this moment. Now, saying what I just said, the IRS still hasn't released a lot of cutoffs for 2022. So there's still a chance that Congress could act and revert back to last year. All right, it hasn't happened yet, but that chance is still pending. So it's one of these things where we need, needing to watch and see what happens. Okay. Now, where a lot of these changes would happen if things revert back to last year is, I think we've all seen in the news, Democratic leadership, they're still pushing very hard for the Build Back Better plan, which is the next bill that would provide more stimulus to the economy. However, we've also seen in the news that a couple senators, most specifically Joe Manchin, has been very, very against the size of the bill. And and even passing a reconciliation bill to get it through Congress. So right now, between Manchin's hold-offs and the other issues that Congress is going to have to deal with in the news, I think it's kind of unlikely that the Build Back Better plan is going to go anywhere at this point. So I think you'd have a difficult time, right? I would have a difficult time saying the child tax rate's going to revert to last year. Plan on the 2000, probably not in advance coming. And the other thing that's being talked about, even if something passes in the Build Back Better plan, in order to get that enhanced benefit, the negotiations right now are saying there'd probably be a $60,000 a year income cap on it to be eligible for it. So if it comes back, it's going to be in it affect a much smaller number of taxpayers than it currently impacted last year. Okay, so I think we're in a wait and see on it. So reverting back, and at this point, not planning on any advanced payments. So that's the first change that impacted a lot of people. Now, the second individual change that I want to talk about today that impacts people has to do with meals and entertainment, or what we sometimes hear about in the media is the 3 martini lunches you've seen people talk about. Okay. Me having 3 martinis for lunch, I don't think so. But some people can enjoy it, and if you can do it and survive it, it's good for you, I guess. Anyway, so historically, the way meals and entertainment has worked is that you have been able to deduct the cost of business meals at restaurants as long as a taxpayer or an employee is present during the meal, as long as it's not lavish or extravagant, and as long as there's a business purpose for that meal. Now, the way it's historically worked is that deduction has been limited, limited to 50%. However, food or beverages provided by a restaurant in the years 2021 and 2022 are 100% deductible. For purposes of 100% deduction, a restaurant can include any business that prepares and sells food or beverage to retail customers for an immediate on-premises or off-premises consumption. Restaurants do not include business that sell prepackaged foods. So no deduction for prepackaged foods. Okay. And the other thing that's sort of interesting here is there were a lot of things that were limited on this back in 2018 when President Trump passed the Tax Cuts and Jobs Act. And where the gray area comes with this is, yes, you get this 100% deduction in 21 and 22, but it is on the meals, but not the entertainment. So one question that very often gets asked is, what happens if your meal is part of entertainment? Okay. So, a hypothetical example right now is we're in March Madness. Let's say you take a client to a game to see a Sweet 16 game. And let's say you have a box at the venue where the Sweet 16 game is being played. So you have the cost of the ticket to bring your guest to the box, but you're also serving a meal in the box. You have the meal in the box, but you also have the entertainment. So you have a gray area here. And this is something that's been posed to the IRS a lot. In terms of gray area, how does this work? So the cost to bring the guest into the box, the ticket to watch the game, that there's not going to be any deduction allowed. However, if the meal or food that you provide in the box is actually billed separately, okay, stated separately on the invoice, saying cost of the ticket and admission to the box is X $100, cost of the food and beverage is X $100. The only thing that you're going to get deducted is going to be the actual meal part of that evening. So the documentation process is what I would say a little more burdensome, but something that if you're entertaining a client, that you need to be conscious of beforehand to make sure that those amounts are separated on your invoice. And if those amounts are separated on your invoice, you get the 100% deduction of the meal for 2022, just not the part of the entertainment. Okay. So again, just making sure it's not lavish, making sure it's a business associate, and making sure it's proper documentation to show, what was purchased, usual selling price, and the reason, and the reason for this dinner. Okay, but it's a pretty broad definition. So that's the second change to look out for. Third change to look out for this year has to do with changes to student loans. And this is an area where there's been a lot of change. There's probably going to be more change as we go forward. President Biden has announced recently another extension of COVID emergency relief benefits for borrowers. And this right now goes through May 1st, 2022. So what does this relief say that goes through May 1st, 2022? The original bill that we call the CARES Act, this was signed into law in March of 2020. And it helped most federal student loan borrowers by temporarily pausing payments and also any involuntary collections of any federally held student loan through September 30th, 2020. The month before it expired, former President Trump signed a memorandum extending this pause until 12/31/2020. Then Betsy DeVos, U.S. Department of Education Secretary at the time, announced that the pause would be extended through January 31st, 2021. In January, this pause was extended again until September 30th, 2021. Now, although administration said this would be it, on December 22nd, 2021, they announced again that this extension would go through May 1st, 2022. So we have to continue a pattern of extensions here, basically saying that payments are paused and we're not going to collect on anything. So what is the cumulative result here of all these extensions and changes? The typical borrower, if you have a student loan held by the federal government, you won't have been required to make any payments on these loans, nor will any interest have accrued on these loans for over 2 years per this administrative forbearance. So in addition, no collection activities, no wage garnishments, and no collection of tax refund. So for the typical qualifying borrower, this extension will automatically continue to pause on any student loan interest, and temporary interest rate is 0. Now, how does this apply from a tax standpoint? Is obviously if you're not paying any interest, you don't have any student loan interest deduction to worry about, because you don't deduct the interest until you pay it, not when it be accrued. And right now there's 0 interest accruing. So that deduction will go away until you start paying interest again. That's the first thing. Second thing to look at with student loans is, as we're seeing in the news daily, a lot of people's student loan debt is being wiped out and forgiven. You owe $100,000 in debt. Next, that debt's being wiped off. People who are qualifying for debt relief versus reasons. Per the code as written, debt relief, you think it's a really good thing, but under the definition of income, if debt is relieved, it is typically income to the taxpayer. So based on the code as typically written, all right, a bank says you no longer owe money. The value of the money that they wiped off is considered income. So you no longer owe income to your bank, but you owe money to the IRS instead. Personally, if I had that option, I'd rather owe money to the bank than the IRS. However, as student loans are being forgiven, this was also happened, back during the housing crisis in 2009, additional legislation was passed that said, if this debt is forgiven, it will not be considered taxable income to you. Okay, so that is in the books right now temporarily for student loan forgiveness also, that if you have student loan debt that is forgiven, you don't have to report it as taxable income. You should not get a 1099 saying that this forgiven debt is income. Okay, and this cancellation of debt is through 2025 right now on student loans. Okay, so the way the law is written, after 2025, if any debt is forgiven, then it would be taxable income. It would be taxable income to you. So that's the next major change that you want to keep in mind as we go forward. The next one that I want to talk to you about, all right, really quickly, is medical expenses. All right. With COVID, we've all of us, all right, have spent a lot of money on medical supplies, such as masks, for example, and other things to get masks, tests, and any other COVID related expenses. All right. These are deducted as medical expenses on your tax return if you itemize your deductions. However, if you itemize deductions, the sum of these expenses have to be greater than 7.5% of your adjusted gross income. So if you're an individual who has medical expenses, including COVID expenses that are above 7.5% of your income, you're getting a tax deduction for the amount that you spend over that. The rules also allow you to use flex spend accounts to cover these expenses. If you take money out of a flex spend to cover these expenses, you don't get the deduction. So fairly straightforward. But it's keeping that, it's realizing that you have to have a pretty large amount of expenses to get any benefit here. Next item, after medical expenses has to do with retirement plans and COVID. Obviously, lots of individuals, job losses, and financial hardship as a result of being out of work and other unforeseen COVID expenses. And what has happened is a lot of individuals took money out of their retirement accounts in order to survive and cover bills during extended periods. So what has happened is if you have a qualified retirement plan, whether it be an IRA, 401k, or any other qualified retirement plan that you have, the way it's worked is if you withdraw money out of one of these plans, okay, from January 1st to December 30th, 2020, okay, you can elect to report up to $100,000 of this distribution over 3 years instead of 1 year. So if I took $100,000 out of my IRA in 2020, normally I'd have to report $100,000 of income in 2020. But the rule has said I can take the $100,000 and spread the income out over 3 years instead of 1 year, though I took all the money out in 2020. And that's the first thing. And what has made this a little more attractive is also a rule that says, okay, I took all this money out in 2020 because I needed it, but now things are better. I have a job. I have income coming in. I can afford to repay what I took out of my IRA. So if you have somebody or you have individually have taken money out of your IRA and now you think you have the resources to pay it back, all right, you can recontribute to that IRA during the 3-year period and have accountants roll over and not pay tax on that money that you've taken out. So if I took money out in 2020, 100,000, and I now have 100,000 in 2021 that I can afford to put back into my account, I can recontribute it and not have to pay income tax on what I took out. And if I paid tax during the year 2020 on what I took out, I can file an amended return and get that money back from my 2020 tax return, or I have the ability to offset that against 2021 tax liability. So they've been extremely flexible here with letting us use our retirement accounts in order to meet this. Okay, so lots of opportunities there. And it's not just IRAs that are governed by this, but it's also a lot of employer plans. So things like government, so things like traditional IRAs, Roth IRAs, SEPs, simple IRAs, 401ks, and other qualified plans, depending on your employer, such as 403B or a government 457 plan. This applies to all of those. And this is something that you can keep in mind because it's going to impact us next couple of years going out. So what I wanted to do for the time that we had here today is, again, just give you a broad summary of what some of these key issues are for individuals, looking at things such as retirement plans, medical expenses, student loans, and the child tax credit. These are the main individual things. For those of you who have business entities, Mark's going to talk about those now. And the other thing that Mark's going to talk about that also might impact you from an individual side, that I'll let him get into it in detail, is if you're an individual who is working from home. If you're that person, you work at a company in the New York City office, and you're now working out of a house in Florida while you're working remote, what are the tax limitations? And Mark's going to talk about that but I'm just mentioning it now because there are a lot of things that are going to come into play on this as on your individual return, even if you're not a business in your own. So with that, I think it's a good transition to turn over to Mark and let him begin to talk about some of the business tax implications that also need to be kept in mind as we navigate COVID. And if you have any questions, there'll be a Q&A at the end of this, and I'm more than happy to answer any questions that you have. Mark, I'm going to turn over to you now.
Mitch said if there are questions afterwards, please submit them. So I'm going to cover four things, the pass-through entity tax, the Section 461L, excess business losses, net operating loss limitations, and remote working issues for both employers and employees. I'll start with the pass-through entity tax. So late in the first year of our former president's term, there was a fairly major tax legislation that went through that impacted everybody that was filing, claiming itemized deductions. And what that tax did, or what that change did, is it capped your state and local taxes at $10,000 per year. To help offset that, they increased the standard deduction so that for many taxpayers, it wasn't an impact, but there were a lot of taxpayers that were still impacted, particularly in the Northeast states where the tax rates are higher. So a number of states started enacting pass-through entity taxes to get around this. And the way a pass-through entity tax works is if you have an investment in a pass-through entity, which would be a partnership or a subchapter S corporation, you can make an election, if you're operating in those states that allow it, to pay tax at the entity level when ordinarily those entities wouldn't pay taxes. And they set the rates similar to the individual rates. And so what happened is that it would shift the deduction to the entity, and as that income from that entity flows into your tax return, less income is flowing through because they've in effect paid the state taxes, and you then get a credit on your personal return for your share of those taxes. So, it started with a couple of states, and then it really got a lot of leverage. And so quite a few states have passed these now, and I'll show you a map in a minute. So again, I'm not sure where everybody's from. New York State has implemented this at the end of 2021. And so you were able to retroactively elect to take that into account for 2021. And then if you wanted to take it into account for 2022, you had to make that election by March 15th. Each state has a different date upon which you have to make the election. Each state uses a different tax rate. In the case of New York, the tax rates vary from 6.85% up to 10.9%, again, trying to mirror the state taxes at the individual level. So what happens is the business entity gets a tax deduction for any taxes paid as a result of this election, and that's how you're getting your deduction that you would have otherwise lost. There's a lot of technical issues with this, though. So one of the problems is that sometimes business entities operate in more than one state, and each state measures that a little differently. So when you make this election, let's say you are operating in New York and New Jersey, and half of your income was attributable to New York and half was attributable to New Jersey. When you make this election in New York, you're only getting the benefit of half of the deduction because you're only picking up half of the income. The other half is allocated to New Jersey, and the New York election doesn't apply to that half. Now, New Jersey may also have a pass-through entity tax and an election you can make, but then you've got to be aware of that. You've got to make both elections. The other situation you can have is you might have all your operations in one state, but your owners might not all be in that state. So you might have owners that aren't active, or owners that maybe live in New Jersey, but the business enterprise is in New York. And so those owners may or may not get the same benefit. And so there are a lot of complexities to determining whether to make this election, which states to make the election for, as well as the timing of all of those. So here's the map. A little hard to see, but most of the states are either have passed these or are in the process of trying to pass them. So, clearly more than half, I think, at this point. And this is now, yet a couple of months old, and some other states have come on board. So, as I explained, let's say you had $9,000 of property taxes and $20,000 of state income taxes on your personal side. That would be $29,000. That's capped at $10,000. If you're an owner of a pass-through entity and you're able to make that election, the $20,000 of state income taxes, if they're all attributable to that pass-through entity, would be shifted to the pass-through entity, and then you'd get that via picking up less income from the pass-through entity, and you'd still get your $9,000 of property taxes. Or perhaps at that point, you'd be claiming a standard deduction, but you'd still be getting an equivalent deduction for your state taxes. So when these rules first came out, there was some question as to how the IRS would view this. And this notice I'm referring to here on the screen was a ruling that they gave that essentially said, we're going to allow people to do this. We're going to accept the states can do this. And it clearly, for some taxpayers, is a way around this cap. For taxpayers that aren't hitting the $10,000 cap, it's not as critical. Or taxpayers that live in states where there is no state tax is not as critical. So when you're looking at it at the entity level, you've got to think about the method of accounting that the entity is on. So a lot of small businesses use a cash method of accounting, but there are quite a few that also use an accrual method. And there can be some timing issues associated with that in terms of when you actually have the pass-through entity pay the payment. And so, for example, we were advising as many as could identify the right amount to pay it before the end of the year if they were a cash basis. There is a position that, because it's a recurring item, that a special rule could be used to deduct it even if you paid it after the end of the year. But the practitioner opinions on that vary. And so, we were just advising people to be safe and pay it as soon as you're going to have to. So some other complexities can also come up relating to how you allocate that deduction at the entity level to the individual owners. So with subchapter S corporations, everything has to be done pro rata or you jeopardize your election. So if you've got two owners out of state that aren't going to benefit from this and two owners in state that are, you can't start fooling around with allocating that to the parties that are affected. It has to be pro rata. With the partnership, you can get different results. There's a lot of flexibility with how you allocate income and loss to partners under the partnership rules. And so there are ways to allocate that. In fact, in some cases, you have to do that to be fair under the provisions of the partnership agreement. But all of those things just add to the complexity. So again, this next slide is just repeating what I was saying before about the New York election. If you're in another state, you really should look at when that state's election is due by. To us, it would make a lot more sense for these elections to be due at the end of the year when you know how much income you have, but that's not how they're doing it. Most of these states also require quarterly estimated taxes for the pass-through entity if you're going to make that election. So be aware of that. But every state's rule is different. So if you're dealing with another state, you really have to do some research or get a tax advisor to help you through that. The next item I wanted to talk about was another rule that came into play in the 2017 legislation relating to excess business losses. So there were a lot of different things going on with that bill. One of them created some very flexible depreciation rules that allowed people to deduct 100% of the cost of assets acquired for business purposes rather than depreciating them over a period of time. This has been coming and going since the early 2000s, and the percentage you could take varied between 30 and 50% most of the time. With this bill, it went up to 100%. And so in connection with that, they implemented some rules to prevent people from just creating giant losses that they could carry back. And so they limited the amount of losses you could pass through under this particular rule. Now, during the pandemic, this rule got suspended for a few years because they were looking for ways to allow people to reduce taxes or get extra funding. And so through 2020, that was suspended. Now in 2021, this limitation is back in play. So if you have a pass-through entity that's got, if you say you're filing jointly, that's got more than $524,000 of losses, you'll be limited to that, assuming you meet all the other rules relating to passive activities and basis issues. If you run into that limitation gets treated as a net operating loss carryover for the following year. So you don't lose it. So if you had a $624,000 loss and you're only allowed to use $524,000, the extra $100,000 would carry over to the following tax year. In this case, let's say 2022. Now, during the pandemic, even though the federal rules on this were relaxed for a few years, New York did not follow that. And so that created some complexities. And if you run into that, now that you're getting into years where you have NOL carryovers for federal purposes, you don't have them for New York, you need to coordinate that carefully. At the same time they did all this, they also changed the rules relating to net operating losses. So these rules have varied over the years from being able to carry back 5 years to 3 to 2 to 1. and then to not being able to carry them back at all. So they reinstituted a 5-year carryback temporarily during the pandemic, so that if you had losses anytime during 2018 to 2020, you could carry them back 5 years. So if you had, income in the previous 5 years, you could recover some taxes from that year. They also allowed anything that was going to carry forward to be deductible in the future at 100%. Now, beginning in 2021, there's an 80% limitation. And it doesn't mean you can't carry your losses forward. It just means you can only offset 80% of your income in a given year. So it'll take you longer to recover. The state rules differ significantly. And so you really have to look at which state you're operating in to know what rules you're under. And then farming losses, they had some special treatment where they allow a 2-year carryback. So I wanted to finish up with a discussion of remote working because, really the whole economy has shifted during the pandemic, with people mandatorily having to work from home. And now as things open up, companies being more flexible than they used to be and allowing people to work remotely full-time or part-time. Some people use this as a chance to move and work remotely from other locations, perhaps where it was warmer, or perhaps where family was. So there's some issues to just be aware of if you're facing that, especially if you're working on your tax return soon. Many states are going to tax you if you're working from home in their state, irrespective of where your employer is. So be sure to check that. If your company is in New York and you're working at home from Maryland or at your parents' house in Florida, you need to check those states. Now, Florida's an example where there's no state income tax, so that's probably not a bad fact pattern, except that New York has a rule that's called a convenience of employer rule. So if you decided to work from Florida when your employer is in New York, unless the employer is requiring you to do that, you can't avoid paying New York taxes. So again, if you're working on your tax return now and you are a remote worker, be very careful about that. From the employer side, they had to assess this as it went, and in fact, many times may not even have really known where the employees were. I don't know that every employee reported where they were working from. But in theory, if the employee is going to be taxable in another state because they've moved, it creates a need for the employer to withhold taxes from that state. Frequently, those employers aren't even registered to do business in that state, so it created quite a few issues for the employers. And having an employee in that state could very well create nexus for the employer for both income tax and sales tax. The other issue becomes, where should the unemployment insurance be paid if the employer is in, say, New York and the employee's in, let's say, Maryland, to use my example? Where should the workers' compensation insurance be paid if someone gets hurt while they're working in Maryland from their parents' house? What happens? What about liability insurance? If you're working from home and you're having things delivered there and someone gets hurt on your property? A lot of different rules. Every state is different. And, just trying to give people an overview of some of the issues that people have had to think about or still may have to think about. So with that, I think we're going to open this up for a question and answer period.
Great, thank you. So this concludes our formal discussion. Thanks to both Mitch and Mark for the information you provided. So we will open it up and answers now. Mitch, I think the first one's individual related, so I'll read that one and bounce it to you. Question about the IRA distributions. I actually had to do that in December 2020 because I unexpectedly lost my job. However, I noted that full amount when I filed my taxes in 2021. My understanding is no.
You are correct. Your understanding is no. If you paid all the taxes, well, first thing, without looking at your situation, I'll be general here, but typically, if you paid everything in 2021, you would not owe anything this year. Again, I would talk to your advisor about options such as if you had the ability to repay it and get any of that money back, that might be an option for you. But you are correct in your assumption. You would not owe anything in the next year.
Okay, great. Thank you, Mitch. Mark, the next question is related to one of your topics. So I'll throw a thumb about the best place to pay remote worker unemployment insurance.
So thanks for your question. It's a question that really any employer that's having remote workers needs to address. And there is no rule of thumb, unfortunately. What we tell people, we've got 50 states and there's 50 sets of rules, and those rules are not even always consistent with each other. So what you really have to do is you have to look at both states, the state where the employer is and the state where the employee is, and see what the rules are. There are a number of states that if you have an employee even work one day in that state, they expect you to withhold taxes and pay all the payroll taxes. There are a number of other states where the threshold might be different. It might be a week, or it might be 10 days, or it might be based on a dollar threshold. So unfortunately, there is no rule of thumb. And the unemployment insurance is typically going to follow, where you're withholding. But the problem, as I indicated before, you need to look at these rules to determine if you're withholding in the right jurisdiction. So, if you're talking about one employee that worked remotely for a week in another state, a lot of people choose to fly under the radar. But if you're talking about a situation where an employee was working remotely from another state for 6 months and you had 50 employees doing that, you wouldn't want to fly under the radar on that. There are so many potential penalties for failing to withhold or failing to pay in these payroll taxes that it's really something that you've got to take seriously and look at closely.
Okay, thank you, Mark. Mitch, the next question is individual related. So this question reads, for school loans, does the discussion refer to federal loans in the student's name? Does it also refer to private loans? What about other loans?
So first of all, thank you for the question. And it applies to federal loans. It does not, I believe it does not apply to private loans. So it'll be federal loans that the student has. If you have private loans, my suggestion would be to talk to the lender, but it is not automatic. It is not automatic in private loans. And if you have a loan where this qualifies, everything is deferred automatically. So if you have a loan right now where you're still being expected to make the payments on it, that loan would not be subject to the COVID relief.
Great, thank you, Mitch.
You're welcome.
Mark, another question for you. Can you recap any individual state tax considerations for owning a home in New York, but working in Florida for 9 months during the pandemic?
So, first of all, Florida doesn't have a personal income tax. So for that person, you wouldn't need to worry about state taxes in Florida. As I indicated before, though, New York has a convenience of employer rule. So the first issue is going to be whether New York will even consider that you're not in New York, irrespective of where you were. So if you were just doing that on your own and it wasn't something the employer required, it's very hard to get past that threshold and avoid New York State taxes. Secondarily, New York State has very stringent residency rules, and it's really two different rules, and people don't necessarily know this, but one of them is based on what's called a statutory rule, which says that you're a resident if you are in New York, more than 183 days during the year. So in your example, it sounds like that person may not have been. The problem is there's a second rule, and the second rule will always trump the first rule. And the second rule is if you're going to return to New York, New York is going to consider you to have continued to be a resident at all times. And so that rule is going to always trap you if you haven't actually, moved. And if you're just temporarily in Florida, New York is going to view that as if you're still a New York resident and still expect New York taxes. And it's probably the number one issue that New York State litigates among taxpayers is people trying to argue that they've changed their state of residence. The state collects tens of millions of dollars from people who thought they could avoid New York taxes on that issue.
Great, thank you, Mark. Mitch, there's a question on meals and entertainment, so I'll read that one for you. With the meals and entertainment deduction, clarify when I can deduct costs if I use a private club to entertain.
Okay, so this is an issue a lot of executives can run into. You're a member of a country club. You pay your country club dues, or your business, whatever. Someone's paying. You're paying your country club dues, and you also use your club to entertain clients. So obviously, the dues to pay the membership of the club are not deductible and not going to provide a benefit. However, if I bring my client to that club and buy my client dinner at that club, the cost of the meal that I pay at that club, the cost for that meal specifically, can be deductible as 100% business expense. And to further on from what I said earlier in the presentation, say I bring the guest to the club, I play a round of golf, and then buy the guest dinner afterwards at the club, I'm going to want the dinner at that club invoiced separately from the fee to bring that client golfing, because I'm not going to get a deduction for the guest fee to bring the individual golfing. But if the dinner is separately invoiced from the golf or lunch, whatever the meal is, I will get 100% deduction of that meal at the club. So, it's a hairy issue, and there's a lot of differences. And having separate invoices with the detail of what you did is going to be key to be able to deduct whatever you can from an expense as it applies to that situation.
Okay, great. Thank you, Mitch.
You're welcome. Good question.
Okay. Mark, this one is related to your topics. Please explain again the main considerations related to COVID-19 for a pass-through entity in preparing a 2021 tax return.
So with respect to the pass-through entity tax, you'll have to look at the state you're operating in order to know if they have a pass-through entity tax and whether you still have the ability to make the election to pay the tax at the entity level during 2021. Some of the states, the deadline's passed, but I haven't looked at every state, so I don't know if that's a true statement for every state. There are other provisions that may come into play at the pass-through entity level that we haven't really covered here today. So for certain types of businesses, there's an ability to exempt 20% of your income, for example, from the pass-through entity, but certain businesses don't qualify, and it would be far too complicated to get into all of those rules, now during the Q&A. But there are certainly other things going on. Some of the pass-through entities may have had PPP loans, or may be able to claim employee retention credits. Again, beyond the scope of what we were trying to cover today, because they're very complex issues. But if somebody's had that, they could certainly reach out.
Great, thank you, Mark. Mitch, we have time for one more question, and this one is related to one of the topics that you discussed. So please explain again why the media keeps saying that taxpayers will be required to repay the advanced child tax credit.
Okay. Yeah, and I think it's really just a spin in words. In some ways, the way you make a headline look good, because if you create a little bit of fear, people are going to read your article. And that's what I think it is. And as I explained at the beginning, a tax credit is just basically the IRS saying we're going to take money off the bill. So I think the example I gave was, if you owe $1,000 in taxes, you have a $100 credit, we're flat taking $100 off of what you owe. So if you're somebody who had a balance that was less than the credit, you're going to get the credit back. You're going to get the credit refunded in advance, and you're not going to have to repay anything. However, where individuals get in the trouble would be if they all of a sudden had a tax liability because they got, if the tax liability is greater than the amount of the credit and they got the credit back in advance. So if you had that tax liability and already took the credit, you might have to pay that tax liability. So you're not really refunding the credit. You're just paying the tax that you owed, where I guess in theory, had you not taken it in advance, they would have offset each other. So, the credit is not required to be repaid. It's just, if you end up owing more money than the credit, so it was more money than you expected. If you're somebody who typically owes money, your tax advisor would probably say to you, opt out, don't take the credit in advance, leave it all there, and then it'll net. But if you're someone who would have usually owed and you took the money, in theory, you're going to have a liability. But there's no requirement that the credit itself be paid back.
Great, thank you. So this wraps up our Q&A session. So on behalf of the Whitman School and Syracuse University, I'd like to thank you for attending our webinar today, and enjoy the rest of the week.